and welcome to the Tax Roundup for January. Inside this month, we're going to take you through the new JobMaker scheme rules. Now, these detailed rules have been released and provide some benefits to employers who are trying to access this rather complicated scheme. We're also going to take a look at the legislative instrument that identifies what state grants for COVID-19 are to be tax-free. Now, also late last year, there was a series of changes made to the immediate expensing rules. Now, not all of those are beneficial to SBEs. We're going to take you through some of the complexity created by these new rules. But first up, Michael Carruthers is going to take you through JobKeeper. We're in the final phase of JobKeeper right now, but there's been a court case before the AAT and also a report by the Inspector General of Taxation that might mean some clients that were previously denied access to JobKeeper or were considered to be ineligible may actually be able to benefit from these changes. Across to you, Michael.
Well, there have been some pretty interesting developments in the JobKeeper space over the last month or two. And what those developments mean is that for some of your clients, it's worth revisiting whether they could actually qualify for JobKeeper. Now, where these developments come from is, first of all, an Inspector General of Taxation report that was issued a little bit before Christmas. There's also been a tribunal case that went through as well, although we haven't seen the end of that yet because the ATO has recently announced that they will be appealing the decision. Now, both of these look to some extent to the integrity rules that are contained within the JobKeeper provisions, but those provisions are almost identical to some rules that we see in the cash flow boost rules too. So keep an open mind around this. It might be some clients who now potentially could qualify for either JobKeeper or maybe cash flow boost. Now, the integrity rules, first of all, require entities to have an ABN on the 12th of March 2020 to access either the cash flow boost or to access JobKeeper as an eligible business participant. Now, the case that went through the tribunal looked at that issue, that ABN issue. In this case, the taxpayer didn't actually have an ABN on the 12th of March, but applied for reinstatement of their ABN after that date. But when they realised that that wasn't going to enable them to claim JobKeeper, they actually called up the ABR registrar and asked for the ABN effective date to be backdated. And it was. So it meant that, in effect, they could argue that the ABN was in place on the 12th of March. Well, the ATO disagreed. The ATO refused to allow them access to JobKeeper, and therefore this matter went before the tribunal. Now, the tribunal said that because the ABR had accepted that backdated ABN registration to prior to 12th of March 2020, they did have an ABN that was effective on the 12th of March 2020, and that meant they could then meet that condition in the JobKeeper rules. Now, the ATO has said that they don't agree with that position. The ATO's view in an interim decision impact statement is that that is a point-in-time test. On that day, this person did not have an ABN. This was something that was fixed up afterwards. And so the ATO is still maintaining that they were correct, despite the AAT's decision, which is why the ATO has appealed this straight to the full federal court and has asked for an expedited hearing. So hopefully we'll have a faster than normal outcome to this, which is a bit time sensitive because really the deadlines for a lot of people for accessing older JobKeeper payments, the cash flow boost, have kind of expired. So it would need the ATO to be a little bit flexible around some of the timing. So that's the ABTET case that went through the AAT, but we will wait and see more. But just have a think about clients who might be in that sort of scenario. I suspect it's a little bit limited, but worth just having a think about clients who missed out on either the cash flow boost or JobKeeper because of that ABN requirement. The other development, as I alluded to earlier, is the Inspector General of Taxation report. This was a report looking at basically how the ATO had managed both JobKeeper and the cash flow boost schemes. Look, by and large, the Inspector General was actually quite complimentary of the ATO, but had noted that there had been a number of complaints from businesses and practitioners and professional bodies around how the ATO had administered certain aspects of the rules. Now, the point I just want to pick up right now is that the Inspector General made this, I guess, interesting comment around some of these integrity rules. Some of you may be aware that to access JobKeeper as an eligible business participant, not only do you need to meet the ABN requirement, but you need to have either had some business income for the 2019 year and notified the ATO of that by the 12th of March 2020, or to have made some supplies in a tax period that ended before the 12th of March 2020 and notified the ATO of that. Now, what the Inspector General of Taxation report notes is that The definition of supply for the purpose of these rules is very broad. It can include input tax supplies like financial supplies. That could include something as simple as opening a bank account. That could be making a supply which could, if done in the right period, allow access to JobKeeper as an eligible business participant. Well, there's also this requirement that you've notified the ATO of the supply. Well, the Inspector General report says there is nothing in the legislation that says you have to have done that on an activity statement. You just need to have notified the Commissioner. As an example, you might have applied for GST registration and given your bank account details as part of that registration process. So you made the supply by opening the bank account, you notified the ATO of it by giving those details to the ATO as part of the registration process. Again, if that was done by the relevant date, you could now have a basis for accessing JobKeeper when you didn't think you did before, or maybe the cash flow boost rules as well. Now, as I said, worth revisiting and thinking about clients who've been denied or you didn't think would be able to access JobKeeper or Cash Flow Boost, and just thinking whether now there might be some basis for changing that approach. But just be aware though, there are still some very strict timing rules, particularly in the JobKeeper system in terms of when that supply was made. The rules apply quite differently depending on whether you have quarterly tax periods or monthly tax periods, and for many people that will end up being a pretty crucial distinction. For entities that aren't registered for GST, seems to be the way it works is that you default back to the treatment for quarterly tax periods. So we still need to be quite careful about this. Don't go and kind of waste your time seeking something from the ATO when it really just isn't available. But it is worth, again, just having that think about clients who might have been denied access. Maybe some of these developments give them a chance. So it's worth being a bit open-minded around it. The tricky thing is, though, the ATO said they're not going to go and revisit every possible case around this. They've said it's really up to taxpayers and their accountants to identify where there might be an opportunity and to then approach the ATO explaining what that is and maybe seeking additional time to provide information. So now over to us to identify those clients and take the appropriate steps.
Now across to Matthew for the release of those detailed JobMaker scheme rules.
If a business is hiring and looking to increase their payroll, then the JobMaker hiring credit is probably something that's worth looking into. Anybody that's looked at the JobMaker hiring credit should realise that it's a complex set of rules to navigate. What initially made the rules quite difficult was that there was some extremely tight timeframes for clients to enrol. We were hoping the ATO would extend the lodgement timeframes, and the ATO and Treasurer have released a legislative instrument which essentially extends the enrolment timeframe effectively for 3 months, 3 to 4 months. So if you're looking to enrol in the first JobMaker period ending on the 6th of January, the original due date for enrolment would have been the 6th of January, but now that's been effectively extended until the 30th of April. So now's the time to look at your client base and look at who might be hiring. And it's important just to be mindful that even though the lodgement enrolment timeframes have been extended, the ATO won't be accepting enrolments past the extended due date.
Now Michael is going to take you through those changes to the immediate expensing rules.
Now, there's been so many changes to the instant asset write-off regime, accelerated depreciation rules, and now immediate expensing rules. It's actually becoming quite difficult to keep track of how all those rules fit together. Well, we're not going to delve into that in detail right now, but one recent development in that area is some of you may be aware that there were some concerns raised with the government around being forced to take an immediate write-off for assets when for some people that actually made their tax position worse. And the whole point really behind these immediate expensing rules that have been introduced quite recently is that it's meant to encourage businesses to go out and spend money and stimulate the economy. Well, people aren't going to do that, or they won't be motivated to do that if they actually get a worse tax outcome as a result of these new rules. So the government has listened to, I guess, those concerns, and a bill was passed through Parliament over the last month or so, which now allows entities the option to opt out of claiming that immediate deduction under the new immediate expensing rules, and also opt out of the accelerated depreciation rules. Well, there's a problem with this though. While I'm sure the government had good intentions and thought they were fixing the problem up, it seems like there's a bit of a gap in the changes that have actually been made. Certainly from our reading, it looks like that opt-out choice is available to entities that are not small business entities. It seems to also be available to entities that are small business entities but choose not to apply the simplified depreciation rules. However, it doesn't look like that choice is available to small business entities that do choose to use the simplified depreciation rules. And for some people, that's going to cause a really odd trade-off. They might want to choose whether to be able to claim an immediate deduction for certain assets, but to do so, they have to choose to come out of the simplified depreciation rules, which might mean they'd then lose access to some deductions that they would otherwise get and otherwise would be happy to take. So it's going to be, for some clients, a bit of an odd trade-off between those two things. So really just something to be aware of, that yes, this bill has been passed. It does give some choice to some taxpayers over whether to use the new immediate expensing rules and the accelerated depreciation rules. But be aware, there'll be some clients who actually don't have that choice because they're SBEs and they are using the simplified depreciation rules. Now for us, it's really just a matter of making sure that clients are aware of the options and the flow-on impact of making those choices. That won't always be an easy thing, depending on the sorts of assets that have been acquired by clients over the last 12 months or so. But that's the sort of analysis that will need to be done to help clients make that decision where they are SBEs, whether to use the simplified depreciation rules, particularly for the 2021 year or not.
Now across to Matthew to look at what state government COVID-19 grants are tax-free.
Many clients are assuming that government COVID grants are essentially tax-free, but that's not necessarily the case. The starting point here is that government grants, when paid to help businesses continue to operate, are generally accessible. However, legislation was introduced last year that essentially provides a framework that allows certain COVID grants to be tax-free. However, this exemption is actually quite limited. Firstly, the grant must be announced on or after the 13th of September 2020, and the grant must be paid during the 2021 income year. The Treasurer must also declare that that specific grant be tax-free as well. As of last month, the Treasurer has only issued that declaration for 6 Victorian state grants. Secondly, there are conditions that apply to the entity receiving the grant. The entity must be carrying on a business and it must have an aggregated turnover of less than 50 million. So the takeaway here is that when you're looking at government grants, don't assume. Sometimes, or for most of the times, they are accessible, but in some cases there can be a specific exemption that's available. And in particular, this exemption is only available for Victorian state grants as of today.
And that's the tax roundup for this month. If you're one of the many professionals who has yet to complete the FASIA exam by the end of this year, then take a look at what Knowledge Shop has to offer. We have face-to-face workshops, we have online workshops, and we also have the on-demand training that you can do at any point. All of our training is designed by industry experts and designed to help give you that knowledge that you need to get through the exam, not just tell you what you do and don't know. Take a look at knowledgeshop.com.au/FASIA or just give Lee Marshall a call on 1800 800 232. We'll look forward to speaking to you soon.